Good afternoon. I'd like to share with you some thoughts about Bank Marin and moreover about the banking industry. In this discussion, I want to share with you some key metrics and some charts that I think reveal why Bank of Marin has been an outstanding performer among U.S. banks over the past decade. I want to introduce to you a term called risk-adjusted return on equity, which I think is the hallmark for the banks in the country that have demonstrated the greatest discipline and ultimately produce consistent and reliable returns. And then in closing, I want to offer to you what I think may be some threats facing not only Bank Marin, but the banking industry going forward. Let me start with a slide that shows you the performance on net income for the bank since 2003. And what you see here is a picture that's kind of an anomaly in U.S. banks. You see here a fairly steady growth in earnings over the last 12 years. In contrast, if we were to put up a slide similar for the industry as a whole, you'd see a big drop in earnings in 2008, 2009, 2010. Well, this consistency, this kind of reliable performance has proven to be unique in the industry. What's the metric that I really focus in on is the risk-adjusted return on equity. And to produce that, I start with a long-term view of profitability. That's the first bar in this graph. It shows the average return on equity over the past 40 quarters. And what we see here in Bank Marin's case is 12.3% average return on equity. The second bar on the graph is equally important, arguably even more important, because what I show here is the volatility or variation in those quarterly returns over the 40 quarters. And what you see here is a standard deviation of the returns of 2.3%. Ultimately, it produces what I call the risk-adjusted return. Take the average return on equity minus the standard deviation, and you get a 10% risk-adjusted return on equity. Well, you'll see that that is at 10% uniquely better than the industry overall. And that's where this next slide makes that point. What I now have added to the picture is a view of other banks in the country that are publicly traded with assets between $1 billion and $10 billion. And what you see in the first red bar is an average return on equity over the 40 quarters of about 450 basis points lower than that at Bank of Marin. The second red bar shows the volatility for these banks is actually twice as high as what you've seen as a long-term investor in Bank Marin. Ultimately, the third bar then is the most important because it shows the risk-adjusted return for the industry, the peer group industry, at about 1/3 of that experienced by Bank of Marin. Well, that leads to then an important observation about shareholder returns, which are created either through stock price appreciation or dividends. And so this next slide looks at stock price appreciation over the past 10 years. What you see here is at year-end 2005, a stock price that has now grown over the 10 years of 65%. In contrast, the U.S. banks overall that are publicly traded, the hundreds that I track, they have a median return of actually -5%. In other words, the shareholder in most banks in this country have actually experienced a decrease in the stock price. Safe to say, Bank of Marin is uniquely among the top performers in the country with a 65% appreciation. Now, as I said, there are two measures of return to shareholders. The second one is dividends, and that's what this next slide looks at. If you're a long-term shareholder, you may take this particular slide for granted, but you need to know that Bank Marin is among less than 10% of U.S. banks that are publicly traded that have seen their dividend grow annually since 2004, 2005. The majority of banks have actually either eliminated their stock dividend during the 2008, 2009 time period, or they had to reduce it fairly significantly. There are threats to the industry, and there will always be threats. That's just the nature of industry. The first threat is a weakening economy. Banks are a barometer of the economy. Banks thrive with a 3%, 4% GDP, gross domestic product growth. Banks do not do well in a recession. Recessions reveal the least disciplined banks and punish those most severely. Well, that leads to then the second threat, and this second threat is related to undisciplined banking practices. And sadly, in our industry, there is abundant evidence over the past 3 decades of a large number of undisciplined banking practices. As a result, we've had nearly 3,500 bank failures during that time. Undisciplined banking practices can be very contagious to banking practices of even the best banks in local markets. And so it's particularly important to be mindful of banking practices across the competitor landscape. And then the third particular risk that I'm observing, and this is a relatively new one for the industry, it's been building over the last 10, 15 years, and that is a steady growth in the amount of capital. Now, this is sort of a two-edged sword. The good news about a steady growth in capital is that it does provide protections for shareholders and regulators in case of a recession. Problem, though, is that for the very best banks, and I'm going to look at this slide with you for Bank of Marin, the growth in capital arguably is unnecessary. And as the amount of capital increases in the very best banks that have demonstrated the most discipline, it ultimately does act as a drag on shareholder returns. I would argue that the best banks actually require less capital than banks that have had less consistent, less reliable returns. So let me close with 2 main thoughts. One, what I think makes Bank of Marin stand apart from the industry is its record for risk-adjusted return on equity. Now, there's no guarantee that past performance will create future success, but what I see that stands out in my mind about Bank of Marin as a shareholder is that this bank has disciplined banking practices, understands what disciplined banking practices produce, and ultimately has a track record of consistent and reliable earnings.